Part 1, Chart of Accounts, COA, 1. What is a chart of accounts? A chart of accounts, COA, is an organized listing of all accounts in a company's general ledger. Each account represents a specific category of assets, liabilities, equity, revenue, or expenses. The COA enables an organization to organize, record, and analyze financial transactions systematically. Point 2. Structure of a chart of accounts. The COA typically divides accounts into major categories. Here's a breakdown of a standard COA. Assets. These are resources owned by the company. Assets include cash, inventory, accounts receivable, equipment, and property. Examples: cash, accounts receivable, inventory, equipment, property. Liabilities. These are the company's financial obligations, such as debts and loans. Point 3. Account numbering system. Each account in the COA is typically assigned a unique number for easy identification and organization. A basic numbering convention might look like this: 1000-1999, assets 2000-2999, liabilities 3000-3999, equity 4000-4999, revenue 5000-5999, expenses 4. Purpose of the chart of accounts. The COA helps in organizing financial data in a clear, systematic way, providing an efficient structure for generating financial reports, ensuring accuracy and completeness in financial records, facilitating internal and external audits by providing a comprehensive list of all accounts. Part 2, General Journal 1. What is a general journal? The general journal is a primary bookkeeping document where all financial transactions are initially recorded in chronological order. Each entry in the general journal includes the date, accounts affected, amounts, and a brief description of the transaction. Point 2. Structure of a journal entry. A standard journal entry includes date, the date the transaction occurred, accounts affected, the accounts that are debited and credited, debit and credit columns. Each entry must have equal debits and credits to maintain balance. Description. A brief explanation of the transaction. Point 3. Double entry accounting system. The double entry system is the basis for journal entries. For each transaction, at least two accounts are affected. Total debits must equal total credits. Debits typically increase assets and expenses, while credits typically increase liabilities, equity, and revenue. Point 4. Sample general journal entries. Here are a few examples of typical journal entries. Example 1. Cash investment by owner. Date: January 1, 2024. Description: owner invested cash into the business. Journal entry: debit, cash asset, $10,000. Credit, owner's capital, equity, $10,005. Pointing to the general ledger. Once transactions are recorded in the general journal, they are posted to individual accounts in the general ledger. This process allows for the tracking of all changes in each account and provides a basis for financial reporting. Point 6. Purpose of the general journal. The general journal helps in providing a complete record of all transactions, ensuring accuracy through double entry accounting, facilitating easier error identification and correction, serving as a reference for audits. Part 3, Practical application and best practices. 1. Consistency and regular updating. Maintaining a consistent COA and recording transactions in the general journal regularly ensures accurate financial tracking. Each entry should be made as transactions occur to prevent inaccuracies or omissions. Point 2. Periodic review. Periodic reviews of the COA and journal entries help in identifying any unnecessary accounts or incorrect entries. These reviews also assist in optimizing the COA structure. Point 3. Use of accounting software. Many businesses use accounting software like QuickBooks, Xero, or SAP to automate the COA and journal entry processes. These tools help in maintaining real-time records, generating financial statements quickly, and reducing manual errors. Point 4. Adherence to accounting standards. Following accounting standards, such as GAAP or IFRS, ensures that the COA and general journal are organized in a manner that meets regulatory requirements and industry norms.